Hey, everybody that's watching, I'm going to shut down the original feed, and I'm going to switch over to here because it looks like it's a whole lot better on my phone. So we're going to stop the camera, leave the studio, and go do it the old-fashioned way, you know. Okay, all right. Okay, so good afternoon. Me again. All right. What's that? Well, actually, I'm going to go ahead and put it in here. Actually, yeah, if you don't mind. That'd be cool. All right, let's go ahead and we're not going to need this anymore. Okay, I see Robbie. How are you? Can you see me? Can you wave? Just want to see if you're getting me now. I'll just go ahead and put this here. Boom. Okay, let's go put this sideways. You can't turn your phone while recording. Okay, well then I won't. All right. Michael, good afternoon. How are you? Thanks for tuning in. Let's see. Okay. Let's see what that looks like. Okay. All right, we'll just have to move the board back a little bit. We can have that because we can't. Okay. All right. Let's go this way. Let's tilt it down a little bit. Everybody? Okay, Valerie, how are you? Thanks for tuning in. Katie, how are you? Excellent. All right, people are starting to hop over. Sorry for the technical difficulties. You know, sometimes you try to get fancy and you should just do it the old-fashioned way, you know? Okay, can you see the board there? You can see both sides of it, I hope. All right. Okay, and you get to see a little bit of my ceiling. I have the landlord change that, that ceiling tile there. Those are the things I notice as a former property manager. Okay, that's good. Did that get us? Mm-hmm. Okay, perfect. All right, so take two. Okay, good afternoon. Here we are, back talking about the 3 secrets of commercial valuation. As I mentioned, the underwriting formula, the cap rate formula, as well as the difference between underwriting different property types. So, what we're going to be talking about first of all is what's called the underwriting. And as I mentioned earlier, underwriting is simply the process of determining the value through looking at the financials of a property. So, to break it down in the simplest sense, okay, you have income, you have expenses, and you subtract your expenses from your income, and you come up with what's called your net operating income, okay, or NOI. And if you've ever dealt with any sort of income producing property, then you'll have heard NOI, NOI, NOI. Everyone wants to know what the NOI is. All it is, it's when you subtract your expenses from your gross revenue in the simplest form. I'm going to get a little bit deeper into it, but just to give you the building blocks, okay? So, this is the formula that you will be using over and over and over again whenever you're determining the value of an income-producing property. Now, mind you,
and can we flip to a non-selfie side so that the writing is
I'm
correct?
trying to, but it says I can't do that.
Is that just a setting? Or like, you know, when you flip your phone?
You can't turn your phone while recording. Yeah, it says I can't. Yeah.
Okay, because the writing is all going to be flipped.
Oh, you're right. Oh, this way. Oh, okay. Well, then can you just set this up on the other side of the desk, perhaps? With the... Oh, when you say non-selfie, you mean like non-mirror image?
Yeah.
Ah, I see. Okay. Yeah. Okay.
And then
Like that. Okay. We gotta make sure that's framed right.
Yes, so I'll go check here.
Oh, there. Huh. There you go. You see?
Yeah.
We're good?
Yeah, we're good.
Okay, we got the whole board in here?
Yeah, the whole board.
Sweet. Okay, here we go. So, as I mentioned, the process we're going to be going through of underwriting, it doesn't just pertain to commercial properties. It's really any property that produces income. Property brings in money, expenses go out, you determine your net operating income, and from there, when you apply the capitalization rate, you're able to figure out what the value of the property is. Here's how you do it, okay? So, whenever you have a property, you have money coming in. Very, very simple. So you're going to have your income, right? Okay. So you're going to have your expenses, minus expenses is your net operating income. Now, once you have this number, you're able to apply a multiple to it. And a multiple is nothing more than a cap rate. So, whereas a cap rate is typically expressed in a percentage, a multiple is a number. If you ever remember from math, 100 divided by 10 is a 10 multiple. It's also 10%. So it's just 100 divided by whatever the number is. Okay. So, for instance, an 8.5% cap rate would be a 12 multiple. 100 divided by 8.5 equals 12. Very, very simple. So you use multiples to go up and percentages to go down. So the math shouldn't be confusing, and I'll show you what I mean. So if you have 100, you split it 8.5 ways equals 12. Okay. So if you had a 8.5% cap rate, is the same as a 12 multiple. Okay. Because 8.5 times 12 equals 100. Does that make sense to everybody? Okay, good. So when you hear me talk about multiples, you hear me talk about cap rates. For anyone that's ever studied stock market investing, they don't use cap rate per se, but they use, when you're talking about the value of the stock, they oftentimes use multiple. They'll talk about what the market is trading at, and it's a multiple of earnings. In this case, it's no different than a multiple of net operating income. And I'll show you what that means. So this is the basic formula. Income minus expenses equals net operating income. You then apply a cap rate to it, and you get your value. Okay? Super duper straightforward. And now what we're going to do is we're going to do a deep dive on this formula. Okay? So, from there, you have your income from rents, plus other income. Now, can anybody tell me in the chat what they think other income might be with a commercial income producing property? Any guesses? Income from rents is very straightforward, but give me something in a let's say an apartment building. What is something else that would bring in income? What was the guess? It was
Laundry.
Laundry. Okay, that's a good one. All right, so that could be laundry. All right. What was another one? Did I see
Parking?
Parking. There we go. Okay, good. All right, perfect. Two good examples. There are other things, but those are oftentimes the big ones. Okay, so you have your income from rents, you have plus your other income. All right, and that gives you your potential rental. Now, you're always going to have B and C, okay? You're always going to have some degree of vacancy. You're always going to have some degree of collection issues. Smaller properties, maybe not so much, but over a long enough time horizon, you're always going to have vacancy and collection, right? So right now, for instance, we're in the middle of the coronavirus pandemic, and some people, they lost their jobs, they're having a little bit of a tough time paying, so we're seeing more collection issues now than we saw, let's say, 6 months ago, right? So you always have to take from the potential, the total possible, and you take out vacancy and collections. Sometimes people might have the money, they just don't want to pay you, okay? So, you take your potential rental income, you subtract your vacancy and collections, okay? And you're going to get your So, money comes in from rents, money comes in from other items, money goes out or it's uncollectible, or you have a couple units open, and you wind up having what's your effective. Okay, so now let's talk about the other side of the coin. Okay, so now we know what our income is. Okay, we broke it down multiple ways. Now let's talk about expenses. So, there are two types of expenses in a income-producing property, right? We have what are called operating expenses, okay, and then we have capital expenses. So, and there are a slight difference, but it's important to know operating expenses are regular, recurring expenses. So, if someone could throw out, give me an example of one of the operating expenses. Electricity, okay. Yep. So if the landlord, let's say, typically the tenants are going to pay for their own meter, but if, let's say, you had lights for the parking lot, and you needed to keep that going, or maybe, let's say, you needed to air condition a common area in an office building, the landlord would pay for that. Anybody else in the chat? Good. Landscaping. Okay. Excellent. Okay. So let's break that into a couple pieces, right? So you have electric. Okay. You have landscaping. Okay. What are some other things? What's the one thing that we all hate to pay? Property taxes. Okay. All right. We got property taxes. Okay. You have
HOA.
HOA. Good. Okay. In this case, that's on the ownership side when you own a condo, right? But the HOA fees are nothing more than your operating expenses, right? So the tenant or the owner of a condo pays like HOA fees. That's a real good one. That's the other side of the coin. This is from the HOA side what they have to pay out of pocket, right? So and then they collect it in the form of an HOA fee. That's a really good point. So you have what's called CAM, and that stands for Common Area Maintenance, right? So that could be the guy with the leaf blower who cleans up the parking lot. That could be the guy who sweeps or mops the hallways. It could be, it can, but sometimes it's broken up differently, but it can be the janitor that may clean the bathrooms in the common areas. Anything that isn't specifically designated for tenant A, tenant B, tenant C, and that is usable by all of them is called common area, and it costs money obviously to maintain them, so you have what's called common area maintenance charges. Okay.
Insurance.
Yep. Insurance, good. Property insurance, okay. All right. Anything else? That's pretty much it. So, I should say those are the big boxes, right? You can always have different line items. Like I said, janitorial in office is oftentimes broken out separately because they have what's called a full service lease. So not only do you pay a certain amount for your office, but the janitorial staff will literally come into your office, empty your trash can, vacuum the floors and so forth. And that's included as part of the lease. So yes, so big picture, you have your income minus these expenses. These are operating expenses, remember? Because, for instance, we have capital expenses, right? So something that is not regularly recurring. So, for instance, the average life expectancy of a roof is, let's say, between 20 and 25 years, right? Well, that's not regular, and that's not normally recurring, right? So, that's not something that you would put in your underwriting, okay? So, what you want to think about it is, okay, so that's something that is from an accounting standpoint is handled separately. It's not something you're able to write off each year. But something else that would be a capital expense would be, let's say, an air conditioning unit that might last you 15 years. You can depreciate it over time, but you can't use it as a regularly recurring operating expense. Okay. So as I mentioned, income minus expenses equals your NOI. Okay. So and to write this all in one big chunk, okay, so you can take a look at it, is potential rental. Get that rental income. And tell me if you can see that or if I'm writing too small, if you don't mind. You have your vacancy and collections, or vacancy and credit losses. It means the exact same thing, okay? And you get your effective rental income plus other income, like we talked about, coin off laundry, it could be parking, okay, other income. Okay, you get your gross operating income, okay? You subtract out your operating expenses minus, also known as OPEX, okay? There's OPEX and CAPEX, or operating expenditures or capital expenditures, okay? And you come up with your net operating income or your NOI, okay? That's how it breaks down in a big fashion. Does anybody have any questions on this so far? Because this is the holy grail here, okay? If you know this and know this inside out and you're able to apply it, you'll be able to underwrite just about anything. Just about anything, yeah, just about anything. There's going to be some nuances, like I mentioned, which I'll show you, but conceptually, this is what we're talking about. Income minus expenses equals NOI. Potential rental income minus vacancy and collections equals effective rental income plus other income equals gross operating income minus operating expenses equals your net operating income. Anybody? Let me know. Want me to keep this? Keep it, go. All right. Okay, perfect. So, what we have here, that's the foundational underwriting formula. And what we're going to do is we're going to put together a real world example in real time. Okay? So, let's say, for ease of use, right? So I'm gonna abbreviate everything. So, potential rental income. Okay? And have your minus vacancy and collections equals your effective rental income plus other equals gross operating income minus operating expenses equals NOI. So, put it on the left-hand side of the board so we can do some examples and walk you through this, okay? So, potential rental income. Let's say you have a building. We're going to use real ballpark numbers. Let's say you have $1 million building, okay? Or I should say, the building brings in $1 million in gross revenue a year, okay? And let's say we're in a pandemic and they have a 5% rate of vacancy and collection. So you have a 2.5% vacancy and 2.5% uncollectible rent, which is actually kind of low. So, but for simplicity's sake, let's just say it's 10%, right? 5% vacancy, 5% collections, okay? All right, so you're looking at 10% total, so we're going to do 10% of that, okay, is $100,000 per year, okay? So you're going to subtract that, and your effective rental income is going to be $900,000. Everybody with me so far? Raise your hand. Anybody in the chat? Everybody? Give me a wave. Thumbs up. High five. Fist bump. Anything? Cool. Okay. So, now that we have our effective rental income, we know that the coin op and the parking brings in another, let's call it $30,000 a year. Okay? Big complex, you know, it's bringing in $1 million, $30,000. Okay? So, you have $930,000. That's your gross operating income, $930,000. So this is what you are actually bringing in. Now, with your operating expenses, let's say you have $50,000 in taxes. $50,000 in taxes. Let's say your insurance is another $20,000 a year. 20. It's getting harder to draw. Okay, so that and insurance. Okay. And let's say the landlord has to pay $5,000 a year in electric. And let's say another $2,500 a year. $2,500 a year in lawn. Okay. And then let's see what else we got. Taxes, insurance, electric, and then let's say another $2,500 a year in common area maintenance. He has the guys come out and empty the cigarette containers and blow the parking lots out and trim the trees every once in a while. Okay, a couple $100 a month, right? So what you would do is you would take all these numbers here, okay, add them up, and subtract them from 930,000. So you guys can add that up for me. First one in the chat with the right answer gets a gold star. Come on. What do you got? Who's it gonna be? Who's gonna be?
80,000.
Anybody else? Anybody else? Yeah, I do this a 10-second lag. Yeah. And I did this way on purpose. You'll see.
It's still just straight. Now, yes.
Okay. Boom, 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 boom. 50, 25, 75.
Ayla says 870.
Ooh, it's close. It's close. Check it again. 50 plus 20, 70. Plus 5 is 75. Plus another 5 is close. Last call. Last call. Okay, here we go. That answer equals 80,000. Okay? Now, so you have your gross operating income of 930, your OPEX of 80,000. You subtract 80,000 from the 930,000, and you get 850,000. Okay. Does that make sense to everybody so far? See where those numbers came from? And the cool part is, you never do this stuff by hand. Like ever. Like ever. I do this every day, and I never do it by hand, because you make a spreadsheet once, you make sure the spreadsheet populates, and you plug in the numbers. It's really simple. Really simple. So, and at the end, for those of you that stick around and watch the whole thing, I'm going to send you my spreadsheet. I'll give you a link to my spreadsheet, and we'll go ahead, so you can use the actual one that I use to underwrite properties every single day. And it's very, very straightforward. And all you have to do is, once you know what these categories mean, then you just plug in these numbers. Without knowing what the categories mean, you're going to be all over the place and you won't be accurate. But once you do it by hand, it's like the math teacher. I remember I taking calculus in college, and they showed you the long format, and at the end of the day, they said, oh yeah, by the way, you can just do it this way, and it saves you about 8 steps. So that's what I'm going to do for you. But knowing this is 3/4 of the battle, right? So you have your NOI of 850,000. Okay. So what that means is, at the end of the day, with all your money comes in, all your operating expenses go out, you are left with $850,000. Now, if you don't have a mortgage, okay, that's what you put in your pocket, you know? Well, you gotta pay on this thing. But that's your bottom line number, okay? If you have debt service, that's a whole other situation entirely. That's beyond the scope of what we're trying to talk about here. But bottom line, 850, that's your bottom line number, okay? So now the question is, once we know what the net operating income of something is, how do we determine what the property is worth, okay? So that's going to bring us to step number 2, all right? So as I mentioned, I told you I was going to explain to you the 3 different secrets, so to speak. They're not such secrets if you can Google them and find them, but number 2, cap rates. So we came across the underwriting formula. We have a general understanding of how that works, okay? We're going to be heading into cap rates. Does anybody have any questions? I understand there's a little bit of a lag, so go ahead and fire them off if the previous, if there's anything that's unclear. I'll wait a few seconds. Looking good. Okay. All right. Everybody's fired up. Okay. You all had your coffee apparently, and you see the brains are, all the synapses are firing. Good. Okay. So we're going to move on to cap rates. Now this is, you know, when I started the group and people started coming in, to a large degree, I tried to reach out to every single person and say, tell me something you want to learn about. Tell me something you want to know about. Give me what challenges you have. I asked about 4 different ways. And you know what wound up coming up? Cap rates. Bar none. I mean, literally, for every other challenge that other people were having, there's probably 5 more people that said they want to understand cap rates. Awesome. Let's do it. Okay? So, this is the most elusive concept in commercial real estate brokerage. And once you get it, you're like, really? Is that it? Really? That's all? Yeah. Yes. And there's a lot of nomenclature in finance, and people like to throw around jargon terms and that sort of thing. So once you get comfortable with cap rates and how they operate, it's literally multiplication and division, nothing more. Okay. So, all right. Capitalization rate is the rate of return of a real estate investment based on the income that it is expected to generate. Okay, so, and now mind you, a cap rate is nothing more than a snapshot in time. Okay, the cap rate today is not necessarily the cap rate tomorrow. Okay, because if something changes in the formula, which there are 3 variables, any one of those variables changes, and it's gonna change the cap rate. Okay. So, or I should say, any of the two of the 3 variables change, it's going to affect the cap rate. Here's what I mean, okay? If you understand the basics of how cap rates are formulated, it's Irv. Talk to your boy Irv. Holla at your boy, okay? IRV, okay? Can anybody tell me what the I might stand for? Anybody? If we're talking about income-producing properties, income-producing real estate, can anyone tell me what the I might stand for? Ladies and gentlemen, woo! Okay. All right. Booyah! Income, okay? Now, here's where it gets a little trickier, okay? R. When you're talking about different things, when you're talking about real estate and rates of return, what do you think R might be? Okay, we're talking about cap rates, okay? R stands for rate. Tell me, this stuff is really not as complex as people would like to make it out to be. I promise you, I'm going to demystify it for you, okay? And V, okay, is nothing more than the market value of the property, okay? This is very, very straightforward. So, market value, okay? Now, oops, there's a U over there. Okay, so there are 3 forms of this particular formula, okay, and it's just by putting one on top versus the other, and I'll show you what I mean, okay. we're going to do a very, very simplistic calculation, okay? So everybody gets income, they get rate, and they get value, okay? IRV, cool. Simply put, I equals R times B, okay? Everybody get that? So, and in this particular case, right, your income is going to be your NOI, okay? Your rate is going to be your cap rate, times the value of your property. So, just like any math formula, right? If you know 2 of the 3 variables, you can determine the 3rd, right? So in this case, right, we have $1 million property, okay? $1 million is the value. $1 million, okay? Okay, and you have a 10% cap rate. Cap rates are always expressed in decimals or percentages, right? So it's times 0.10, okay? What would the income be on a property that's market value is $1 million and it has a 10% cap rate? What would the income being produced be? Fire it off in the chat. Show me what you got.
Well, that's coming. And there's a question from Leila before. It's what is the percentage rate for vacancy during these times?
Good question. That's going to depend. So the question is from Leila, what is the vacancy rate for properties during these times? Okay, it depends on the property type, right? So, I mean, we have seen unprecedented levels of unemployment. I mean, we went from super low, 4% or so, all the way to like 24%, depending on what, you know, and those numbers could be fudged. But the point is, it quintupled, basically, in a very short period of time. So we haven't gotten all the data yet, but, for instance, industrial was at about 2% nationwide. It's now between 4 and 5. Okay, industrial has fared the best so far in the pandemic because what I like to say is industrial is the new retail. You know, so if you go back 10 years and you figure on all the things that you used to buy, you'd walk into a brick and mortar store, you take your goods to the register and you pay for them. Now you don't do that. Now you hop on Amazon. Now you hop on, Alibaba. You hop on whatever, HomeDepot.com, and this stuff comes right to your house, right? So because people are continuing to utilize industrial properties, they have the best vacancy rate. So if I was underwriting an industrial property, I'd plan for, let's say, 5 or 6% at this point, right? Multifamily, which depending on the submarket, if you're in the hottest submarket around, you might have, let's say, 5%. If it's in a rougher submarket to rent in, maybe there's very transient, or maybe a lot of people moving in and out. You're going to be looking at an 8 to 10%. So what that might be now, properties might be 15% vacant, or the vacancy and collection rate, like we talked about before, could go up to 15% or even 20%. It all depends on how the property is managed. It depends on how the relationship the landlord keeps with the tenants. So, and then that goes a long way, in terms of, if the landlord took care of the tenants in the good times, the tenants will hopefully repay the favor in the bad times. So that's multifamily. Retail, right now, I can only imagine, we've never seen anything like this. In 100 years, we haven't seen, since the Spanish influenza, we haven't seen anything. But if I had to guess, I would say retail is probably going to be 30% empty by the end of the year. If we were at, let's say, 85% full, it might drop down to 70% empty. 70% full, maybe 60% full. There's going to be a lot of people that are going to be going out of business. If things continue the way they're going. And then finally, office. You have everybody working from home, and they never did before. So you're going to see a lot of businesses, as they're coming up on their renewals, downsizing. So you're about to see a huge, we haven't seen, because commercial real estate moves a little bit slower, a lot slower than residential, we haven't, those numbers haven't kind of come in, we haven't been able to aggregate that data because we're 120 days in, but we'll know better by the end of the third quarter into the fourth quarter. So great question, Leo. Okay, so
You got 100,000 from Katie.
Katie with the gold star. All right. So we get 100,000. Perfect. Okay. So you have your value, you have your cap rate, you got your NOI, right? Now let's change this up a little bit. Okay. So we've got an NOI of 50,000. Okay. And you've got, let's make this fun. Let's say your NOI is 50,000 and your cap rate is 8%. Okay. What does that make the value of your building? How do you figure that? How do you solve for this? Okay. So if you remember from high school algebra or whatever, when you move something on the other side of the equation, okay, you move it on the other side of the equal sign. Instead of it being multiplied over here, it's divided over here. So what you do to solve this is you take, or I should, instead of a question mark, Mrs. Shriver would hate me, my high school algebra teacher, x, okay, and it's going to be times x, okay. You're going to have 50,000 divided by 0.08 is going to give you the value of the property. Go ahead and shoot it off in the comments.
Getting 625
What do we
from
see?
2 people.
Okay.
Robbie and Katie.
All right. Let's get some people in here. So
It's a little one.
let's see. Right at that point. Okay. Do the math. The calculator will never lie to you. Just as a funny little side note, whenever I'm pitching properties and I'm going in for a listing appointment, I remember seeing this survey, and they profiled, I think it was something like 40 different business types, the different industries and whatnot. And like the butt of every joke is used car salesman, right? Everyone says, this person's like a used car salesman. They're oftentimes, not all of them, but oftentimes regarded, as pretty much bottom of the barrel for some reason. And then yet, doctors and so forth are way up here, in terms of people trusting them and are they trustworthy, right? And of the 35 or 40, whatever it was, industries that were profiled, real estate agents were 3 from the bottom. So it was used car salesmen, 1 or 2 others, and then real estate agents, right? So, and I know this. So I go into a listing appointment, and people are already not trusting real estate agents. So what I say to them, I said, listen, brokers will tell you stories. I admit it, but the numbers will never lie to you. Okay, because you cannot dispute a pencil, paper, and simple math. Okay. So in this particular case, it's no different, okay? We have 2 variables, we solve for the third. You take the 0.08, you move it to the other side of the equation, you move it under here, and if you are doing the math correctly, 625,000. Okay? Awesome. So we had, who all answered it correct? Who gets a gold star?
Robbie and Katie.
All right, Robbie, Katie, great job, okay? So now, to review, we figured out what the income is when you knew the value and the rate, okay? We figured out what the value was when we knew the income and the rate, okay? So now, this, keep the sign here, okay? So now we're going to go back to, all right, we'll go back to that $1 million property. Okay. Let's see. Let me add another Get carried away with my zeros. Okay, boom, boom. All right, so now, we know what the value is, okay? And let's say the income is 74,000. Make it a non-round number. Now that we're getting a little more complex here, okay? So, income equals R times V, okay? So income equals this. It's going to be the R times 1 million. Anybody else? Anybody? So this times this equals this. Go ahead and put it in the comments. And if you're getting a little stuck on it, we're going to do the exact same thing as we did before, okay? When you move something to the other side of the equation, you divide, okay? So, that divided by 1 million equals that, if that makes it a little bit easier for you. That's going to be the math rate, okay? So, $1 million property, $74,000 NOI.
7.4%.
All right, let's see if our math is right. Anybody else? Robbie, you out there? Layla? Talk to me. Talk to me. What's the percent going to be?
Robbie, yep, 7.5.
Okay.
4, sorry.
Okay, all right, 7.4%. You said 7.4%? You sir would be right, okay? Pretty simple, right? The math is very easy. You put it up here, and you can even put a spreadsheet in your computer of the 3 different formulas. So you plug in 2 numbers, you figure out the third. Very, very simple. But I wanted you to be able to do the math by hand, the old-fashioned way, so that you know how to do it in a real-world scenario, okay? Because sometimes you'll be out in the field, and you got to think on your feet, and you won't always have your spreadsheet in front of you. So, now let's get a little bit more complex, all right? Now these are easy. This is math you can do off the top of your head, right? I'm going to give you actual numbers for something. So, let's say that the income is $68,946, okay? And the cap rate is 6.25%, okay? What is the value? Okay. Give you guys a few seconds. Anybody? Robbie? What do you got for me? Talk to me.
1.1 million from Robbie.
Okay.
And the exact number?
Let's go with the exact number.
Katie gives the exact number 1,103,136.
Okay. Who else had that number there? Okay, Misha had it. Bobby had it. Katie had it. If you had that number, you would be correct. Okay? Now, very simple so far, right? Multiplication, addition, subtraction, pretty straightforward. This is a $1.1 million property, okay? There's no difference, and when I say no difference, I mean no difference, zero, none whatsoever, between underwriting a property, I'll show you why, that is, okay, 1.1 million and 1.1 billion. Literally no difference. Now, not a lot of properties have $68 million in NOI. I recognize that. But instead of being, 3 zeros, instead of an M behind it, it's a B behind it, okay? Now, properties don't trade in the $1 billion range all that often, but we do see, if you had an NOI that looked like this, if you had an NOI that looked like that, can anybody tell me what that number would be? So if you had an NOI of 689,460, okay? Can anyone tell me what that would be?
Bobby says 11.42 million. He's rounding.
That's fine. Yep, for the purposes of this conversation, yes. So, the only difference between knowing how to value a $1 million property, or $1.1 million property, and an $11 million property is a decimal point. $1 million property, $11 million property. $110 million property. Literally, that's it. That's why once you know this stuff, it doesn't matter if the property makes $50,000 a year or $5 million a year. You know how to assess the values because you understand the basics, the basic fundamental building steps of underwriting, okay? So, if you're comfortable with these so far, we can move a little bit further, but I want to make sure everyone has this because this is such a key component. So I'm going to give you a couple seconds. We got a little bit of lag on the camera, so go ahead and fire off. If anybody has any questions, tell me to stop right now, and I'll be happy to clarify anything for you. So far, so good? Okay. Give you people another couple seconds, see if you have any questions or whatnot. And if not, then we'll move on to the next step. Step D. we're good. All right, so as we mentioned before, cap rates, what they are, okay, it's the rate of return that's expected on an income-producing property based on the income that it's supposed to generate, right? So we know what they are. All right. Now, what we need to know is where they come from. Why would why would property in Atlanta be selling for an 8 cap, and Miami be selling for a 6.5 cap, and Chicago might be selling for a 4 cap, and New York City might be a 3 cap? Why? Where's it come from? And where did these numbers? Why aren't they all 6 cap? Right? If you asked that, I'm glad you did. I'm about to explain it. So, cap rates come, to understand cap rates, you have to understand a couple things. Whenever anyone is looking to purchase a piece of real estate, they're doing it because they're trading money for risk, okay? So what they're doing is when you buy an income-producing piece of real estate, you are buying an income stream. Now, you're buying an income stream that you don't know 100% beyond a shadow of a doubt it's going to be here tomorrow. Right? So, higher risk, higher reward, right? That's not an unfamiliar concept to most people. So, for instance, if you were in the best submarket in an area and you were to buy a piece of property, you would probably pay a very low cap rate. And something to keep in mind, that cap rates, okay? So you got, this is your cap rate, your value, okay? When the value goes up, the cap rate goes down. They are inversely related. When the value goes down, the cap rate goes up. Here's what I mean, okay? This is where it starts getting fun. So, if you have your same, let's go with $1 million property, $1 million property, 10% cap rate, okay? All right? What's the NOI? What's your NOI? If you said 100,000, you'd be correct, okay? This would be $100,000. Okay? Okay? Now, you take this same formula, right? Okay, and rather than this being 10%, it's 5%. What would that number look like? Right. So, at 5%, it's only worth 50. Okay? So, what happened, right? The rate of return, okay, or a snapshot in time is a cap rate. The rate of return changed, and it changed the income, okay? So, in this case, the cap rate, the cap rate went down, okay? And the income, the cap rate goes down, income goes up, right? Okay. You getting that right. Okay, so, it's like a seesaw, all right? So, more importantly, okay, when you have NOI of 100,000, go back to that. NOI of 100,000, okay? Cap rate of 10. Value is, anybody? 10%. Value is going to be 1 million. Okay? $100,000 a year, 10% cap rate, 1 million. Ready for this? Change that 10% to a 5%. What happens to that value? Go ahead, shoot it in the comments for me. I want to make sure everybody's getting this because this is super important. Cap rate goes down, what happens to the value? Cap rate goes up, what happens to the value? Inversely related, like a seesaw. Okay, so in this case, we went from 10 down to 5, 10%. So 5%. That goes down. What happens here? Yeah, so it's going to go from 1 million up to 2 million. Does that make sense? Okay, so first scenario, 10%, 1 million. Second scenario, 5%, 2 million. You with me? Okay? Same scenario, right? Like this. Keep the value here. Same seesaw. Same seesaw. This is the inverse relation seesaw. All right? We're going to go from same $100,000, okay? We'll start off with a 10% cap rate, okay? We're going to start off with our 1 million, but instead of going down to 5, you're going to go up to 12% cap rate. When the cap rate goes up, what happens on the other side of the seesaw? Exactly. Now, this math you can't do in your head. Tell me what that's going to be. Go ahead and fire it off in the comments for me. I don't even know the number. I gotta check the calculator. But I do know how to do it. Okay. So again, seesaw, inversely related, $100,000 NOI, 10% makes it $1 million. Seesaw goes up on this side. The cap rate goes up. The value goes, instead of being $1 million, okay, it's going to go down because the cap rate goes up. Seesaw, and it goes to 833.333. Bobby gets a gold star. I like it. He's on it. All right. So, if you can get your head around this, you are 90% of the way there. I promise you, it gets no more complicated than this. But even at times when you're fast, you're thinking and you're speaking, sometimes inverse relationships are not easy to. They don't come as intuitive as direct relationships. Up goes up, down goes down. See what I'm saying? But yeah, if you can get your head around this, now I'm just gonna take it a step back and I'm gonna show you why this works this way. Okay, in the first part of the equation, I took 100,000 and I divided it by 10% or 0.10, and I got 1 million. Okay. Second part of the equation, it went from 100,000, dividing it by 0.12, and I got 833,333. Okay? Everybody get that? And then that goes back to the I equals R times V formula. Okay? And mind you, like, this is not going to be, it's not going to get any more complex than this. Okay? So if it takes you a couple tries, well, what I want to do is I want to walk you through the steps. Once you walk through the steps, you get a little bit better at it. But this is, if you can understand the concept initially, then chugging in the numbers and chug and plug is very, very simple. Okay? Does anybody have any questions? I'm willing to stop right this second to answer anything, because if you're not asking now, if you're getting a little bit fuzzy here, it's going to get more difficult as time goes on. So, like I said, we're 90% of the way there, so I'd love to clear anything up right now. So I'll hold off.
I just want to say, Katie made a comment that this section was her aha moment this week.
Boom! Awesome. Yeah, it takes a little while, but once you get it, the light bulb goes off and you're, is it really that easy? Yeah, it's really that easy. This stuff is brain surgery. Yes, Leila.
Leila says, how do you determine the cap rate?
That's what we're coming to next. First, I want to show you what it is. Then I want to show you how the pieces move together. And we're going to get down to is how it's determined. I started to tease it a little bit before with the different cities, but I wanted everyone to understand the relationships. But we're coming right to you there in just a second. Awesome. She's on top of it. Love it. Everybody good? Is that good? come back to it, but I'm just giving you all an opportunity right now. Okay? So, we got the seesaw, right? Everybody understands the seesaw. I'm going to read this like this. Get this out of here in case we need to refer back. Cool. Okay. So, we understand cap rates. We understand what they are. We understand how the different pieces fit together, okay? Now we want to know, where do they come from? Where do they come from? Okay, so, opportunity cost. As an investor, as I started to mention before, you're trading risk for reward. You're trading X amount of dollars for an income stream to come in the future. In a tougher, unproven submarket, or maybe a submarket that's transitional, you're going to have higher cap rates, okay? Meaning there is more reward for your dollars. So for instance, if you put in $1 million into a property and it's a 9% cap rate, you're going to get $90,000 in NOI a year, right? In a neighborhood that maybe it's coming around and the values haven't gotten to where they're going to be yet, right? But if you're in a proven neighborhood and it's what I call the crown jewel of an area, you know, we have an area called Coral Gables, right? And that's a really beautiful area, very nice. But the thing is, the cap rates are very low, which means the values of the property are high. Remember the seesaw, okay? The cap rates are low, so you have to spend a lot of money for properties there. But the surety of that money coming back to you, the level of surety is very, very high. You know, because it's already proven, because it's very stable, everybody wants to be there. You don't get a lot of return, but you don't have a lot of risk either. So that risk-reward relationship is a lot lower. Okay, a lot of lower risk, lower reward. Okay, but if you go into an area that's just coming around and it's changing and it's blossoming and it isn't quite proven yet, you're going to have a higher risk, but you're also going to have a higher reward. Okay, so your cap rates are also going to be higher. So mind you, cap rate and value, okay? Cap rate, value, inversely related, okay? Cap rate and risk are directly related. Higher cap rate, higher risk. Lower cap rate, lower risk. Everybody with me there? Okay? So, where do they come from? This is Layla's question, okay? Where they come from is a couple things. One is your opportunity cost. So, let's say, so somebody, do me a favor, fire off in the comments what city someone's from, what area they're from, what region of the country. Try to give a real world example. Layla, Robbie. Okay. I want to make this help this drive this point home for somebody that's not from, say, South Florida or from Miami.
Atlanta, later.
There we go. Okay, Atlanta. All right.
Philly, Robbie.
Where's Robbie from?
Philly.
Perfect. Okay, I know those cities a little bit. Okay, so for instance, Atlanta, right? When you have the downtown area, right? People are going to pay higher cap rates because they want to be right in downtown. Okay, they want to be able to walk everywhere. They don't want to be stuck in that Atlanta traffic, right? And if you've ever been in Atlanta on a Friday afternoon, you know exactly what I'm talking about. It backs up like crazy. So your cap rate in the downtown area is going to be a bit different than let's say if you're out in the burbs, you're in, let's say, Norcross, right? If you buy, all things being equal, a 10,000 square foot office building in downtown is going to have a different cap rate than someplace north, you know, or outside of Atlanta. You go to, I don't know, Tifton or Cairo or someplace outside, you know, an hour or two outside of Atlanta. The surety of the return on their investment is lower, so the risk is higher, so therefore the cap rate is going to be low. Okay, Philly, right in downtown Philly, you know, as similarly, an office building is going to be highly coveted, right? If everybody wants to be in that area, or if they need to be in a certain area where all that's booming, let's say an apartment complex, where all the yuppies live, and it's a lively and vibrant area. I think Center City, right? So if you have some place like that, as opposed to you go out to the suburbs, you're half hour outside the city, go to King of Prussia, say, right? And you're going to say, wait a minute, they're going to, for the people that want to be right in the city area, they want to be where things are happening, you're going to have a much lower cap rate, because and therefore the values are going to be higher, okay, but the risk is less because the places are more popular. It's like, so if you go to a nice restaurant, right, that's fancy and is very, very popular, you're going to pay more for the food oftentimes because they're highly coveted, right? Similarly with properties, okay? So just to drive that home, so what you're talking about opportunity costs is, okay, do I want to go to a place, well, in submarkets, this submarket has a higher cap rate than the other submarket because one has a higher level of, or the other one has a higher surety of return of your investment, okay? And then also, you got to look at opportunity costs as it pertains to what else could you do with this $1 million, right? And that's where cap rates also come in. There's no universal cap rate in the sense that you're trading your $1 million for, let's see what you can put it in the bank for, right? In the bank, what are you going to get? 0.7%, I mean, T-bills a couple of years ago, they were almost at 3% now, I don't know, 0.6, 0.7, it's ridiculous. The point is, you put your money into something that's guaranteed and sure, you're not going to get much return at all. The chances of you getting your money back from the bank, if your bank is FDIC insured, is very, very high. So they're going to pay you less than 1%. So you have to take some risk if you want to make a higher return. So you evaluate your opportunity cost or the cost of taking one option versus another. I did a live the other day, and I was talking about the opportunity cost of you working on a Saturday versus going to the beach on a Saturday. Okay, you go to the beach, you hang out, you have an awesome time, you make memories, fantastic. Or you could have worked and maybe made $1,000. So your opportunity cost for going to the beach is the $1,000 that you could have made. Similarly, in real estate, if someone decides, okay, I'm going to take my money, my $1 million, and I'm going to put it into a building, and I'm going to earn a 7% rate of return. So I'm going to earn $70,000 NOI, we've done before, okay? Or I'm going to put it into the stock market, and well, maybe if I buy the GE, maybe I'll make a 4% return. Maybe if I buy some tech stock, I'm going to make a 20% return. So those are your opportunity costs of taking one investment versus another, okay? Applying your money to one decision or another, okay? So, if you really want to break it down, the way investors look at things, okay, is they look at their opportunity costs, what else, what other buildings are performing at in the area. So, but more importantly, you have to look at what are called cost of funds. And the cost of funds is what it takes, what the APR is on a loan that you would take, okay? So for instance, if you go to the bank and they say, okay, this building brings in X amount of money, we're gonna loan you the money to buy it, but we're gonna charge you 5% a year to buy it, okay? If you were to go to the bank and your cost of funds, or the APR on the loan, okay, is 5%, would it make any sense in the world for you to buy a building that produces income at a 5% rate of return? Do me a favor, answer in the chat, because this is super duper important. You have to understand this to understand where cap rates come from. So go ahead, I'm going to wait a second, wait for the lag, and go ahead and fire off in the comments.
In the meantime, I'll ask Robbie's question.
Yes.
What is the typical range of cap rates, or how high can or do they get?
Awesome question. That is a great question. Okay, so to answer Robbie's question, there is no typical range of cap rates, okay? Because it has to do with, one, your opportunity costs, and two, what your cost of funds are. So, right now, you can get, I was just checking out, prime rates yesterday were 3.25%. 3.25%. It is ridiculous how cheap money is right now. But yet if you went back to the 70s and 80s, we had unbelievable interest rates. For instance, I know my father bought a car in 1982, and he had a 16% interest rate. Now, it's hard to put your head around that, because so who's going to pay 16%? Yeah, but when inflation is, let's say, 12%, it's not so bad, right? So there isn't it's a moving number, it's a moving range, okay? But typically, you're going to see if your cost of funds are, let's say, in today's day and age, you can get, if you're going to buy a house, you can get 3.25%. If you're going to buy a building, commercial, there's a bit more risk than a house, because people will do anything not to lose a roof over their head. So that's the best chance you're going to have of getting repaid is on someone's house. Commercial properties, slightly less, so risk is higher, cap rate's higher, right? So you're going to pay about 4.25 for some of the best, the best credit rated borrowers. Maybe you pay 5 or 5.25 if your credit isn't as good. Okay, so if your cost of funds is let's say between 4.25 and 5.25, all right, you're going to want to buy a building with a cap rate of approximately 2% higher. Okay, I'll get back to that in a second. Any answers in the? No. What did Katie say?
Nothing really.
I think I just talking. Okay. Yeah. So getting back to it, right? The question was, does it make any sense for you to borrow money at 5% and earn a return of 5%? Or I should say, does it make much sense to buy it at 5% or to borrow at 5% and earn at 5%? If you said no, you'd be correct. Okay. Similarly, does it make any sense for you to borrow at 5% and earn 4.5%? No. Why? Because you're paying to own that building. Unless, the only scenario that I can think of, that it would make any sense for you to borrow at 5% on a building that's making 4.5% return on your investment, is if the building is going to increase in value. So if there's going to be some sort of huge capital appreciation, you buy it for $1 million today, and next year it's going to be worth $2 million, then you say, you know what? I know this area is turning around, and developers coming, something, the city's going to buy it, they're building a new arena, and they need this piece of property. My property's going to have a capital appreciation. Then it makes sense to buy less than your rate of funds. But unless you absolutely know that there's going to be some serious capital appreciation, it makes no chance. It makes no sense to do so. Okay? So that begs the question, and this goes back to Robbie's question. What's the range? Typically, when you can borrow money at a 5% rate of return, what would an investor want to borrow? Something higher than 5%, okay. But then the question becomes, what? What you want to borrow money at is at least 1.5 to 2 points of spread above your margin, above your cost of funds, okay? So if you're borrowing money at 5%, you want to be at least 6.5% or 7% rate of return, okay? Why? Because with buildings, as we saw before, right, we saw there's vacancy issues, there can be collection issues. Here in South Florida, we could have a hurricane. Out in California, you could have an earthquake, you could have tornadoes. All kinds of unforeseen circumstances can occur, so you have to have a buffer. You have to have a buffer so that you protect yourself. In case that rental rate doesn't come through, that you're not losing money and paying to own this property out of pocket every month. Does that make sense? Cool. Okay, so to answer Robbie's question, you're going to need to see typically, and I like to use just for good round numbers, 2 points of spread. So if you're buying at 5%, you have a property that's going to produce a 7% rate of return, that's when it makes sense. So anything from 7 upwards makes sense, and the higher the cap rate you can buy it at, the more sense it makes. But you usually don't want to go below 2%, maybe 1.5% of spread. I wouldn't do it. It's just too, when the thinner that margin gets, the more trouble you can get into and the less of a buffer you have. Okay? So that should explain where the cap rates come from. Does everybody understand that? So it has to do with, one, your opportunity cost. So what other properties are producing in the area, okay? It has to do with other submarkets, right? How much risk tolerance you have, so are you willing are you willing to go in a risky area that the prices might shoot up, then you'd have a higher cap rate. But if you want to go to an area where it's super safe and secure, you're going to have a lower cap rate, okay? And then it also has to do with your cost of funds, or what it costs for you to borrow money, okay? Borrow money, and then the spread that you need to give you a bit of a buffer to make the investment make sense. Does that make sense? Go ahead and shoot off in the comment section for me. Wait for it. Wait for it. Okay. Awesome. Cool. All right. So we know what. We know how. We know where they come from. Those are the 3 questions for cap rates. So to review a little bit, okay? I told you today when we started this class that we would go over the underwriting formula. Income minus expenses equals your NOI, okay? We'd also talk about cap rates. We talked about the relationship between cap rate, okay, which is your R, income, and value, okay? And we discussed the 3 different ways, the I equals RV formula. If you can remember 8th grade math, you know how to, when you move something on the other side of the equation, you divide, and then you're able to determine by changing any one of the 3 variables what the other 2, or any 2 of the variables what the 3rd variable will be. Okay? And then finally, the differences between underwriting different property types. So, I know a lot of brokers, people that own commercial real estate brokerage companies, are not going to want to hear me say this, but I'm going to let the cat out of the bag. So many brokers love nothing more than to have their agents that work for them specialize in one property type, okay? Ask me why. Say why. I don't know. I know it doesn't do any good for the agent. If you can learn a property type in, let's say, a year or 2, get very comfortable with it, and understand the market fundamentals and how the property operates, that's good, right? But there's no sense in doing that for the next 30 years because you don't get, 100% better every year. At a certain point, there's a point of diminishing returns where pretty much everything there is to know about that, right? Why would you not expand your tool belt, right? Why would you not expand your skill set so that, let's say, I don't know, a pandemic hits, you have something to do, you have something to hedge your bets, right? So, the economy cycles, right? If any of you guys took Econ 101, right? It's, you got your boom, you got your bust, okay? You got your expansion, and you got your contraction, right? And none of this can stop this, right? And it's a big circle. And it keeps on going, and to go from boom to contraction to bust to expansion to boom, all that, it used to take on average 7 years. This case, it took about 12 years to happen, okay? From 08 all the way back to 2020, took about 12 years to get, or I should say, from 08 all the way back around to 2020 is where we are now. So when you're going through these things, you have to understand that certain property types are going to benefit better in different times of the market, right? Now, as real estate brokers, we make money when the market goes up and when the market goes down, right? But if you are locked into one specific property type, unfortunately, your business can die, it can dry up like that. I have friends that are retail brokers, right? And they're telling me, I had 6 properties under contract and every single one fell apart. Why? Because the demand went through the floor for retail. Because you can't even open a bar. You can't keep restaurants open. It's only outdoor seating. And, right now we're in the summertime, that's fine. But what happens if, heaven forbid, we're still wearing our masks and they only allow outdoor seating and it's December in Philadelphia, for instance? What are you going to do? These properties, if you can't utilize the property, you can't bring rent in theoretically, it doesn't have any value. If the income is zero, right? If you take it through the method, right? If the income is zero, okay, 0 divided by 100 is still 0, okay? It doesn't matter what cap rate you put on it. If you can't prove any income, if there's no income coming in, you can't prove the value, right? I'm not saying that the value is going to go down to 0, but it makes it a whole lot harder to sell. That's my point, okay? So, what my suggestion is to everybody that's listening is have the ability to understand and articulate at least 2 property types. I started in industrial. I worked in industrial for many years. I did development. I did leasing of property, of office and industrial parks. So I got to really get a good feel for the industrial market, and that's what I started off. I liked it. I literally started from the nuts and bolts, the ground up of industrial. And then I was working on that, and I said, you know what, there's just not enough properties in my area. I need to expand, and I expanded into office. And I had people say, oh, no, it's going to be too tough. It's going to be too tough. Guess what? You change up a couple little items in your underwriting, and boom, you're off to the races. You learn a few nuances. Once you understand the underwriting formula, you are already 90 to 95% of the way there. And do not let anyone tell you any different, okay? I took my CCIM, right? For those of you that aren't familiar, it's a certification that's in commercial real estate, and it stands for Certified Commercial Investment Member. And they go so deep into valuation of buildings and pre-tax versus post-tax and what happens in this scenario and that scenario. They take you 1,000 feet deep when in 90% of commercial real estate, you need to be about 10 feet deep. You know, and if you can handle that 10 feet deep, you're good. You're good. I mean, the people that get really super involved or super in depth are the institutional buyers, the REITs or the real estate investment trusts. These are the guys that have these big companies, and they buy up properties, and they create a fund out of it, and they want to know, well, if our rental rate in 3 years is X percent, and if vacancy goes to this, and then they have to underwrite for all these different variables. They get a little bit more, they extrapolate out a lot more. But the bottom line is, this right here is the heart and soul of the entire valuation process. If you can understand that simple 6-line formula that we did earlier today, you got this. You couple that with cap rates, I equals R times V, multiply, divide, multiply, 3 variables. You can do that, you put the 2 together, you understand valuation. Okay, you don't need an advanced designation. I thought I did, until I learned it all, and I got my pin, my CCIM pin, you know, there's a ceremony and all this stuff, and I got to the end and I said, wait a minute, I'm only going to use about this much of the whole curriculum. But you know what? It's better to know than not. But my point is, if you understand what I just taught you over the last hour, you got this. Okay, so now, I told you why you want to know different property types, right? A lot of people have different preferences. Some people like the appeal of retail. Some people like office buildings, big, tall, beautiful office buildings. Some people like the grittiness of industrial. And some people like the mom and pop aspect of multifamily. It all depends on whatever suits you. What I would suggest is find 2 that are going to be hedges for the economy. I just happen to like industrial, and I tend to gravitate towards multifamily, right? Because I watched that, because I was managing industrial and office parks last time around, okay, back in 2008, and I watched the park go from fully occupied to 80% occupied in 12 months. Here, it's going to happen, and it's going to happen quicker, because then it was a slow cascading effect. Right now, we just dropped off a cliff because everything stopped. So, I watched the retail be the first to go empty, and I watched 3 years later the last to get rented up, okay? And then I watched the spaces that we were leasing that had more office build out. People started saying, you know what, maybe we don't need these big offices. Maybe we can fit people into a smaller area. So people started paring down. So the point is, I watched this from a management standpoint, watching, you know, we owned all the different property types except for multifamily. And I said to myself, I said, wait a minute, retail, I wouldn't want to touch that. And office, that's really hard. But industrial all day long makes sense. People are still producing, like I said. Industrial is the new retail. And then multifamily is just obvious to me, at least, because everybody needs a roof over their head. No one can say, you know what? I don't need this apartment. I'm just going to sleep on a park bench tonight. Nobody's going to do that unless you are in absolute dire straits. So what I recommend as a hedge against the economy and unsurety is retail and multifamily. Now you don't have to do both of them, but I would recommend if you're going to do office, couple that with either retail or multifamily or both. You know, if you're going to do retail, to couple that with multifamily or industrial. Okay, so something to consider. So the differences between underwriting different property types. So glad you asked. Like I said before, when we were underwriting, okay, right, we got your income here, income minus operating expenses, okay, if I could spell, I'd be good. Valuation, I got that. Spelling, not so much. Expenses equals net operating income. Boom, okay? So, income's income. Now, in an office building, maybe you have some different. You'll have parking for an office building where maybe you won't have that in an industrial building. People aren't typically going to pay for people aren't going to pay for that. So if you talk about your sources of revenue, you got parking, you got laundry, you got rents, right? You have maybe special events, like if someone has a large area. I was just underwriting a property for a potential client the other day, someone that I was pitching a listing to, and they have a big grassy area that they rent out to a school next door, right? So they have special events, right? Okay. These are different kinds of income, right? So you can see, so depending on the property types, okay, whether it's industrial, right, whether it's multifamily, okay, whether it's office, or whether it's retail, okay, depending on office and retail, okay, depending on which one of these you're talking about, yeah, industrial might not have parking. Certainly won't have laundry, but you're definitely going to have regular rents, right? And you might have special events because I've seen people take industrial parks and rent out the parking lots for events. So I've seen them take a warehouse and have a gallery type thing. So sometimes people will do that in industrial. The income that can come from multifamily, you're going to have you could possibly have parking, additional parking for multifamily. Certainly laundry, okay. Special events, sometimes if you have a really nice office or really nice high-rise, they might have a community center where they'll rent out for birthday parties and that sort of thing. So there's going to be some sort of special events. But typically, that's about all you're going to have in terms of income for that property type, okay? Office. You're most certainly going to have parking. Excuse me, if you're in a big city, like here in Miami or Atlanta, Layla or Robbie in Philly, it's congested and you need a place to park, so the parking garage is a big part of that. You're not going to have laundry in an office building, typically. You're going to have, obviously, your rents, and then special events, maybe, type of thing. And then, mind you, these aren't the only ones, but this is going to cover about 80 or 90%. Maybe someone comes up with one or two other ones, but this is the big ball of wax. I'm showing you today the 80-20 of this. Is there going to be some sort of nuance that I didn't mention? Yeah. But is this going to get you a real good feel for the subject? 100%. Okay? So then, let's talk about income for retail. Okay, so you got parking, maybe. Retail oftentimes don't have a lot of parking. A lot of times they do street parking. Or if they do have a big parking lot like Best Buy or something like that, you're not going to pay to park. But okay, maybe you have some parking. Laundry, no. Rents, of course. And then special events, so basically, on the income side for retail, you're talking about basically your rents, not a whole lot of other additional income that can come from that, right? Remember we talked about vacancy and losses and credit collections, right? So industrial, you're going to have vacancy. Let's just talk about a good market because it's hard to estimate anything realistic in the pandemic. But on industrial, let's say you're going to be 2 to 5%, right? Depending on the submarket. On your vacancy collections in multifamily, maybe you're going to be 8 to 10%, you know, in a decent market and in a decent property type, or I should say in a decent submarket. Office buildings, they're a little tougher, you know, depending on where you are in the economic cycle that I just drew out before. You're going to be somewhere in the, let's say, I don't know, let's say 10 to 15%, you know, sometimes it's 20, depending on how well the building is managed. I can tell you, all pricing the same, all building attributes the same, the management company can have a huge difference in the way the building operates. How tough they are on the rents, how good they service the clients, it's amazing. The retention and collections are huge. Trust me, I've seen it. I've seen it. We you know, I like to brag that when we had when I was managing our properties, we had a 7-year period. 7-year period. 125 tenants, not 1 month. Not 1 month of vacancy in 125 units. Why? Because we took care of people. The phone rings, you pick it up, you service them, you take care of them, and when things aren't good, then you work with them. You know, but people, when you take care of them in the good times, they take care of you in the bad times. I promise you. So getting back to it. So retail. Retail, we could watch this, like I was mentioning before, we can watch this go down into 30% vacant, you know, depending on where you are. There are some places like, for instance, Detroit, hit really, really hard back in '08. And there were times that entire areas of the city just were completely vacant. So there's no telling where things are going to happen. There's so much uncertainty right now, but I'm willing to bet that it's going to take about 6 to 9 months, but by the end of the fourth quarter, by the holidays, we're going to start to see some major vacancies here. Okay? So that covers the income and collections and vacancy percentages for the 4 different property types. Okay? Now, let's talk about operating expenses. Okay? And how they're different. Right? So, operating expenses. OpEx. OpEx for industrial, let's say. All right, so you got your, you might have lawn, all right, depending, a little bit of green area. Okay, you're going to have your common area maintenance. The parking lots need to be maintained. You know, you seal coat them every couple of years. You take care of them. You're obviously going to have your insurance. Okay, you're going to have your property tax. Let's see, what else? Lawn, CAM, insurance, property tax. Maybe you're going to have some electric. Okay. Maybe you're going to have maybe outdoor lighting or something like that. If there's some heating, actually, because there's not a lot of common area inside for industrial. You know, typically people going to their own unit. It's not like an office building where you have hallways and that sort of thing. So there's not going to be a lot of electric or gas for heating or cooling. So those are the basic OpEx for industrial. Okay. How is that different from multifamily? Well, multifamily oftentimes has lawn, sure. CAM, yep. Insurance, sure. Property tax, yeah. Electric, What else are you gonna have? I don't know. Maybe a guy to service the pool. All right. Maybe a janitorial staff if you're talking about like a high rise. Janitorial, okay. That's the vast majority of them, right? If anyone has anything else they want to add, let me know. I can't think of it. All right. Office buildings. Okay. Sometimes you don't have lawn, but sometimes you do, right? They're not all necessarily high towers. You're definitely going to have CAM because you have the hallways, you have the common bathrooms, you have maybe there's a cafeteria on the ground floor, that type of thing. Maybe there's a gym, nice amenities, you know. Insurance, for sure. Property tax, yep. Electric, yeah. Pool, probably not. Janitorial, most certainly. Okay, so that's pretty much those are the major bases for office for operating expenses. Okay, and then retail. Okay, you're gonna have lawn sometimes, probably not much, but you might have some. Okay, CAM definitely. Insurance, Property tax, yep. Electric, yeah, you probably have a lighted parking lot, so yeah. Pool, probably not. Janitorial, maybe not, okay? But as you can see, 1, 2, 3, 4, 5, 6, 7 of these categories, and you subtract 1, you add 1, those are pretty much it, you know? For you to look at this formula here, okay? When you look at this formula, When you go to underwrite an office building versus multifamily, you add one item here, you subtract one item there. When you go, instead of doing multifamily, it's going to be retail. You add one item for income, or you add a couple operating expenses. My point is, once you have the basic formula, you can underwrite any of these, and nobody wants to tell you this. Nobody ever told me this. I found out for myself. It's really, once you realize that, just light bulb goes off like a volcano out the top of your head because your mind is blown. This is it. This is the whole thing, okay? So, are there any questions on the third part of our lesson for today? The third secret.
Not the third part, but Leila's asking, do you choose a cap rate based on the purpose of the investment, such as long-term or short-term?
Let's see. It depends, okay? And I hate that answer, so I don't like giving it either, but the truth is it depends on if there's going to be capital appreciation, right? Like I was mentioning before, I would suffice a bit of now income if you're going to hold it. If you're going to say, okay, within 3 to 5 years, maybe I'm going to see some major capital improvement. But for the most part, you can't count on capital improvement, but you can count on today's cap rate. You can count on today's investment stream or income stream. So what I would say to that is, I don't bet on the future. I bet on today, and that's what you're really. So I wouldn't make too much of an allowance for down the road or short term versus long term, unless you really had a very strong feeling that the area is going to improve greatly. There's going to be some significant capital appreciation. Any other questions? Katie? Robbie?
Robbie had to drop off.
Okay, perfect. Okay. Katie, did I clear everything up? Because I know you had some questions. Hopefully. Okay. So, we went through the 3 secrets, right? Went through the 3 secrets, and we saw underwriting formula, how the cap rates apply to the underwriting formula, and the fact there's virtually no difference between these items. Okay? If this is interesting to you, if there's something that you'd like to learn more about, if you're considering commercial real estate and you want to learn this stuff, learn it intuitively, you want to have support on how to do that, I would like to invite you to hop on a call with me and see. I have a coaching program. It's an online training course called CRE Basic Training. I'm sure you've seen the name of the group is CRE Basic Training. I created a 36-lesson course and a coaching support system so that you can have all your questions answered. And on top of that, you can have someone that can guide you, that can help you craft your business plan, that someone who has already done it, someone that can help you along the way. You know, when I first got started in brokerage, my biggest problem was no one had the answers. No one was able to craft it into a program. No one was able to put it into a nutshell. I went out and spent tens of thousands of dollars in training so I could learn all this, so I could then distill it and put it in a package with a nice, neat bow on top. All right. So if you are interested and want to take a look, okay, I have a website called CRE Basic Training. And then .com, and then there I have an application there where you can fill in a little bit of information for me, tell me where you are, where you'd like to be, and we can hop on the phone and we can discuss. I can book it. It's a free strategy session. You can sit on the phone and talk for about 45 minutes or so and get a real feel for where your business is, where you want to go, what your goals are. And if I can help you do that, I would love nothing more than to help you do that. Because there's an old saying, you know, you can't teach a kid to ride a bike at a seminar, right? You know, getting trained and learning a concept is one thing, but reinforcing it and using it and then coming up with a new scenario and, wait, well, this occurred today, what do I do about that? For me, my biggest issue, my biggest hiccup was having someone to bounce that off of, not knowing what questions to ask and not having a resource of someone to explain it to me and break it down. I have prided myself on being able to figure things out, because sometimes you have to figure things out on your own. So what I'd like to do is I'd like to pay that back. I'd like to help others and to see if there's anything I can do to help you. I would love nothing more. I'd love to see light bulbs go off. I love helping people. So if you want to reach out, crebasictraining.com/favor and direct message me in the group, okay? And I will get you over a link to that spreadsheet and be happy to share it with you. So you can take this stuff and start actually speaking to people, underwriting properties, learning the jargon and so forth. And I'd be happy to help you with that as well. Anything else? Anyone else? All right. Well, I think that pretty much does it for today. Thanks again for tuning in. Any questions, feel free to reach out to me. Hope you guys are having a great day. Take care. Enjoy. If you enjoyed this video and would like to see more, I make videos like this weekly on YouTube, so go ahead and subscribe down below to my YouTube channel. See you soon.